So welcome to this video. In this video, we are going to discuss about the topic profitability index, and this question has appeared in June 2014 examination. So we'll start from the required. So required B is what we are going to look at. Calculate the maximum NPV which can be obtained from investing the fund of 10 million, assuming here that the nominal after tax NPV of project E is 0. So project E has to be taken as a 0 NPV. So that is what is here. It is to be calculated and this has to be taken as a 0. So we'll read the question. The board of O has decided to limit investment funds to 10 million for the next year and is preparing its capital budget. The company is considering 5 projects as follows. So they have given listed out the project A, B, C, D and their investment, their NPV. All 5 projects have a project life of 4 years. Project A, B, C, D are divisible, so you can even invest in a proportionate manner. And projects B and D are mutually exclusive. That is, if you select B, you can't select D, and if you select D, you can't select B. So they are mutually exclusive. All net present values are in nominal after tax terms. That is, all the NPVs have been are in equal terms here. Okay, so they have been calculated using a common method. So now our job is to find out which project to invest and which we should not invest. So we'll start. To do this, we need a table. I've already prepared a table so that it will be easier for us to work out. So this is the table. I'll explain you the table and its contents. So to do this sum, we have to do something called as a profitability index, and the profitability index formula is this: present value of cash inflow divided by present value of cash outflow. So once you have done this, you have to choose the higher PI. So PI is the profitability index. We have to choose the higher PI. So that is what we have to choose, a higher PI. So we'll create a table like this. Project from A to E, their initial investment and their NPV. These are taken from the question itself. Okay. Project E has an NPV of 0. So that also we have taken. So our job is to next find out the formula. So we need a present value of cash inflow. So how do we find that? The present value of cash inflow is, you have to add the initial investment plus the NPV. If you add both, you'll get present value of cash inflow, or else we'll look like this. If you deduct present value of cash inflow minus the initial investment, you will get NPV. So it is like if you minus inflow minus outflow, you will get NPV. Here they have given you they have given you initial investment and the NPV. If you add both, you will get the inflow. Okay, so that's how the formula works. So we will get our present value of cash inflow. So we will fill all the columns. So this is our present value of cash inflow. So if you want, we'll do it here. So if you have is equal to present value of cash inflow minus present value of cash outflow. Okay, outflow. So what happens is, we know what is the NPV and cash outflow. So in order to know the present value of cash inflow, what happens is this outflow moves from here and it goes and gets added with the outflow and we get the answer. Okay, if you want, we'll have these numbers here so that you understand how it works. Okay, so that's how we got our present value of cash inflow. So the next one is the profitability index. So the index is very simple. Divide the inflow by the outflow. Inflow is here, outflow is here. So divide it. Inflow 3500 divided by the outflow 2500. So you got the number. So we got a profitability index. The next one is to rank. The higher the better. But here what happens is, E is strategically important, so that's what the question said. Okay, so assuming that here that project E is 0, and this is a strategically important project which the board have decided must be undertaken in order for the company to remain competitive. So E has to be invested. So rank wise, E becomes number 1, D becomes number 2, B is 3, and C is 4, and A is 5. Okay, so we got the rank also here. So next we have to create another table. Okay, so the next table is allocation of funds. So the table works like this. We have the projects here, and we have the initial investment here, and their respective NPVs and their ranks. So this table is like brought from the previous table. We are having like two more columns here. One is the balance of investment. So we have a total of 10 million. So we'll work out how much funds we have. So we have 10 million. So we have to divide it by thousands. We are calculating in thousands. So we have a capital of 10,000, and we have to spread it across these investments in this ranking. So first we'll spend our money here. So we have in hand 10,000 minus, if we invest in this, we are going to have a balance of 5,000 in hand, and NPV that we'll get is 0 because it's a strategic project. And next we will go to D. In D we have 5,000 in hand. If we invest in D, because it's rank number 2, we have to spend 1,900, and balance we have 3,100. But NPV is the full NPV we can invest. So the next one is B. We can't invest in B because it's mutually exclusive. So B and D are mutually exclusive. That is what we have found here. Okay, so B we can't invest, but we can invest in C because C is the fourth one. So we have 3,100 in hand, and we can invest 2,600. So we still have 500. So we'll get the total NPV because we are investing it our full investment. And finally we can invest in A. So A, we can't invest the entire amount because we can have only 500 in our hand. We can invest only 500, so it will become 0. So how much we can invest? We can only invest 500, but the total project is how much? It is 2,500. So we can only invest something like 1 by 5. So our NPV will also be only 1 by 5. Okay, because we invested 20%, so we'll get only 20% of the NPV. So now we can find out the sum. So the sum will be total of all these investments. So we got 3,050. So that's about our investment here. So we can invest fully in E, D and C. B we can't invest because it's mutually exclusive. A we can invest only 500. So we can only invest like 20% of its total capital. We'll also get only 20% of the NPV. So that's about this question. So once you have done, this question is over. If you want, you can highlight certain parts. That's what we are doing here. So this question comes to an end. We will move on to the next question. So we'll start with this sum. So in this sum, we are going to deal with the topic lease versus buy, and it's a December 2013 question, and the requirement is evaluate whether Spotco should use leasing or borrowing as a source of finance, explaining the evaluation method which you use. So we'll start from the question. Spotco is considering how to finance the acquisition of a machine costing 7,50,000 with an operating life of 5 years. There are two financing options. Option 1, the machine could be leased for an annual lease payment of 1,55,000 per year, payable at the start of each year. So we'll start with this. So we'll start with lease or buy. The first one is a lease. So we'll work out this also in terms of thousands. So we'll have a table. We'll have the years. So we'll have some items to type inside. So something like a lease payment. So we'll have only like one single cash flow. So the sum is not giving taxation. So in option 2 below you see taxation must be ignored. So there's no taxation. So we'll start from the lease payment. So lease payment is 155,000. So it is payable at the start of the year. Start of the year means at the beginning. So first year, the 1 refers to the end of the year. 0 is the start of the year. So we pay minus 155 at the start. So we just carry this for 4 years. So the 1 actually refers to the not to the end of the year 1, it refers to the beginning of year 2. So this is beginning of year 1, beginning of year 2, 3, 4 and beginning of year 5. So that's how the cash flows move. So we've got our lease payment numbers. So the next is to find out the discount factor. The discount factor is at, the question would have given you some kind of a discount factor. The machine could be bought for 7,50,000 using a bank loan charging interest rate at an annual rate of 7%. So there's no percentage in the sum anywhere. The only percentage is if the machine is bought, an interest rate of 7% is to be paid. So we can take that as the common discount factor for both lease and purchase. So the first year will always be 1. From the second year we have to follow. So the previous year divided by 1.07. So that's a number. So we can just copy and paste it for all the years. So next one is to find out the discounted cash flow. So that's just a multiplication of both these numbers, add them together, multiply them together, and you got the relevant discount cash flows. The last one is the NPV. So NPV is much easier. So get the sum function, add all the inflows, and you got the answer. So the answer comes to negative 680. So the discounted cash flow, so the discounted cash flow comes to minus 680. So we have to do a similar thing for the purchase, the borrowing and purchase. So we'll copy this table and use it as necessary. So you'll have it here. So it's quite like so we'll take it as purchase. So again, purchase is done in thousands. Particulars is there, and we have a lease payment. Lease payment is not there, so we'll remove this element totally. And these cash flows we'll copy and we'll have it below. So that's, if there's any other cash flow in between, we'll work out here. The machine could be bought for 7,50,000 using a bank loan charging at a 7% interest. So this is a discount factor. At the end of the 5 years, the machine would have a scrap value of 10% of purchase price. So 7,50,000 into 10% will give you 75,000. So that would be the scrap value. If the machine is bought, an annual maintenance cost of 20,000 per year would be incurred. So they are not telling us when it is incurred. So if they are not specifying whether it's at the start or at the end of the year, we usually assume that it to be the end of the year. So maintenance cost is going to occur at the end of the year. We'll start with the maintenance cost. So maintenance cost is a negative number. It comes to 20,000. So we'll have it as 20. Copy and paste it across all the 5 years. We have purchase cost. So purchase cost is on the 0th year. So that comes to 7,50,000. And there's also a scrap value. So scrap value usually occurs at the year end. So the life of machine is 5 years, but the end only it will occur. So that's it. We can have cash flow as a number. So we can add all the numbers from scrap to the maintenance cost, close it, copy it, paste it. We got all the cash flows. Okay, we got all the cash flows. So now we have the discount factor. The discount factor will not change, it will be as same as it is. So we can also extend it by another year to the last year. So we just have to multiply it in DCF, multiply this number into the cash flow. So we got for the first year, we'll do the same for all the 5 years. We got a number, and this, just let's check the total. No, the total is only taking 4 years, so extend it by another year. So we got an answer. Give a suggestion. So our suggestion is, as lease has a lower cost compared to purchase, it is better to lease the asset. So that's what we could do. So as lease has a lower cost compared to purchase, it is better to lease the asset. So that's it. That's about this sum. We'll move on to the next sum. So we'll start from this sum. It is again a lease and buy sum. It has occurred in December 2018. So this question are of two parts. So we'll start from requirement A1. Assuming that the new machine is operated for 3 years period, evaluate whether Melanine Co. should use leasing or borrowing as a source of finance. Again, it's a lease or buy problem. So we'll start and read the entire question. Gemco is considering the acquisition of a new machine with an operating life of 3 years. The new machine could be leased for 3 payments of 55,000 payable annually in advance. So that is about the lease. Alternatively, the machine could be purchased for 1,60,000 using a bank loan at a cost of 8% per year. So this 8% is a common discount factor for both lease and buy. If the machine is purchased, MCO will incur a maintenance cost of 8,000 per year, payable at the end of each year of operation. The machine would have a residual value of 40,000 at the end of its 3-year life. So that's about the information. We have still some information, but that refers to the A2. Okay, so this is the information for lease or buy. We already had the format in the previous problem, so we are using the same format. So we'll start. So the machine has a lease of 55,000 and they are payable in advance. So you have to pay it like this. This is the first year payment, second year payment, and third year payment. So done. And the discount factor will be the previous year discount factor divided by 1.08 will be the discount factor, and just copy and paste it for one more year. You got the answer, and that's it. Check whether the total is taking all the years. It is taking too many years. That's it. So this should be the lease payment NPV. So next we'll check out the purchase option. The purchase option has a maintenance cost of 8,000. So we'll take -8. So at the, he says maintenance cost will be payable at the end of each year of operation. So it is -8, and it's for 3 years. We've done. The purchase cost is 1,60,000. So it is here. So 160. We've done. We also have the scrap value. Scrap value usually occurs at the end of the year, and it's a positive cash flow, and that comes to residual value of 40,000. So we got the answer. We have to get the discount factor Discount factor is divided by 1.08. So we got it for the first year, we got for the 3 years. So just check whether these numbers are pulling it properly, and yes, they are pulling properly. And we have got the discounted cash flow also. And finally, we have to check whether this pulls properly. It pulls too much, and the answer is 148. So here, as the purchase is a lower cost, as purchase has a lower cost compared to lease, it is better to purchase the asset. Okay, so that's about the suggestion. So we have come to an end of the problem. So this is how you have to work out a lease versus buy problem. So we'll move on to the next problem. The next problem is the other part of the same question. So we are going to discuss about equivalent annual cost in this problem. This question has appeared in December 2018. So we are going to discuss about requirement A2. So this is what we are going to find out. So we'll go through the question. Melaninco's production manager estimates that if maintenance cost routines were upgraded, the new machine could be operated for a period of 4 years with maintenance costs increasing to 12,000 per year payable at the end of each year of operation. If operated for 4 years, the machine's residual value would fall to 11,000. So he's asking a 3-year versus a 4-year maintenance, okay, where the machine has to be. So this question takes this paragraph and it wants to work it out. So what they want is, using a discount rate of 10%, calculate the equivalent annual cost of purchasing and operating the machine for both 3 years and 4 years, and recommend which replacement interval should be adopted. So the question asks you whether the machine should be operated for 3 years. The information is given here. Whether it should be operated for 4 years and then sold, that is given here. So the 3-year versus 4-year option. So for a 3-year option, we've already did it in the last sequence. So the maintenance cost is going to be 8,000 every year. The purchase cost is 1,60,000. The scrap value is 40. So we got our cash flow. The only difference here between requirement 1 and 2 is the discount factor. Discount factor here, it is 10%. So these numbers will change. So this number will change to 1.1. So done. So our answer comes to minus 149. We have one more step, that is the equivalent annual cost. So the formula is NPV we have here, divided by, we have to get the sum total of all the discount factors. So first what we'll do is, we'll get the sum total of all the discount factors. We'll have it here, sum total of discount factor percentage. So we have to get that number. So we'll work out that number. It's equal to, don't take the first year discount factor from this year, you take a sum from this year to the end of the year, close it. So this is the sum total of the discount factor. So we'll work out NPV divided by annuity factor or discount factor for n years. So discount factor of 10% for 3 years, it comes to this number. So work out and we'll get the answer. The answer comes to 60.25. So that's about the EAC. So once you have done this, you don't need to do the sum again. You can just copy it and you can paste it. So now we can work out the 4-year option. So just add another year. The cash flows are going to be different. So maintenance cost is going to be 12,000 per year. So convert this to minus 12. So copy it and paste for all the years. So next one is purchase cost. Purchase cost will not change, but the residual cost will become 11. Residual income will be 11. So it is a cash inflow. It is a positive number. The cash flow, you have to extend it for the last year also. So extend it for last year. The discount factor is the same 10%, but you have to do it for the fourth year also. You got for the fourth year. Again, the DCF you have to do it for the fourth year also. So you've got all the numbers. So the NPV should effectively take all the numbers. Okay. So now you got the NPV for all the numbers. Your EAC we have to check because EAC would have typically taken only the 3 years, but we have to take all the decimal numbers of discount factor. So 4-year numbers will be there, and we got our EAC. So that's how it works. So whichever is lower, we have to select. So we'll start from the suggestion. As option 2 is cheaper. Okay, we are working everything in terms of cost. As option 2 is cheaper, it is better to operate the machine for 4 years. Okay, so that's it. We are going to select the option which is 2. Okay, or as option 2, this is our option 2. It's better to operate the machine for 4 years. That's about this problem. So we'll start from this problem. It's another equivalent annual cost. So it has appeared in June 2012. So there are like two projects here, project 1 and project 2. So we are like bothered about project 2, and we have our requirement set in B. Okay, so we'll start. Calculate the equivalent annual cost of machine 1 and machine 2 and discuss which machine should be purchased. So we are bothered about requirement. Okay, so we'll read the question. Ridaco plans to replace an existing machine and must choose between two machines. Machine 1 has an initial cost of 22 lakhs and will have a scrap value of 25,000 after 4 years, or machine 2 which has an initial cost of 2,25,000 and will have a scrap value of 50,000 after 3 years. So it is a 4-year versus 3 years calculation. Annual machine cost of the two machines are as follows. So these are the annual cost. So machine 1 has 4 years, machine 2 has 3 years. Where relevant, all information relating to project 2 has already been adjusted to include expected future inflation. So all future inflation numbers have been done, so we don't need to do anything with this. Taxation and capital allowances must be ignored in relation to machine 1 and machine 2. So there's no taxation or uh, tax allowable depreciation benefit which is like to be calculated. So other information is Ridaco has a nominal before tax weighted average cost of 12% and a nominal after tax weighted tax of 7%. So which one we should take? See, as we are not going to take any tax here, so all these numbers are before tax. We also have to use a before tax WACC only. Okay, only when you are going to deduct tax from this information, you can choose an after tax WACC. But these numbers are before tax, so choose before tax WACC. So we'll start from machine 1 and machine 2 options. So machine 1 option will start. See, all the numbers we are going to work out in terms of thousands. We'll start from particulars. We'll start from 0th year. Machine 1 is going to be operated for 4 years. So we'll start from the maintenance cost. So maintenance cost is 25,000. again it comes to 29,000, then it is a negative 32,000, and finally it's a negative 35,000. So then we'll move on to the purchase price, purchase cost. So purchase cost is a negative number and it occurs for machine 1, it is going to be 2 lakhs. So we take it as 200 and we have a scrap value. So the scrap value will occur at the last year and that is going to be a cash inflow. So the cash inflow is 25,000. So we'll take it as 25. Done. So we'll compute the cash flow. So now we have to have the discount factor. So discount factor is at 12%. That's a before tax WACC. So we'll start. So 0th year it is 1 and from first year it is going to be so we got the numbers. So next one is to find out the DCF. So DCF is cash flow into the discount factor. So we got our discounted cash flows and the last step is to find out the NPV. So NPV will be the sum of all these numbers. So we got NPV. So I have to get the sum total of the discount factors. Okay, or we can just say that it is annuity factor 12% for 4 years. Okay, so that number would be, so take all the decimal calculations that you have made, don't take the 1 and close the bracket. So we got the number. So we'll work out the EAC. So the EAC will be NPV, this number, divided by the annuity factor number. So that will be the answer. So we got for the first machine. So we have to get it for the next machine. So we'll get it for the machine 2. So machine 2 you don't need to work out separately. You can copy from whatever we done here. So the machine 2 workings we'll do. So machine 2 has a cash flow for only 3 years. So we'll cut the 4th year fully and we'll work out. So the maintenance cost would be 15 for the first year. Is going to be 15 for the first year, 20 for the second year, and 25 for the third year. The purchase cost of the machine is going to be different. So it is 2,25,000. So here we have the value and the scrap value is 50,000. So scrap value will occur on the third year itself. So it's going to be 50. So we got all the cash flows. Discount factor will remain the same. There's going to be any change. DCF also will be the same. NPV will be the same. Just check whether it is correct. Yes, we have the same 3 years numbers and this will be our EAC. So we have done it and we can give now the suggestion. So the suggestion will be whichever cost is lower. So machine 1 cost is lower. So as machine 1 cost is lower, we can choose and buy machine 1. So that is about the choice being made. Current annual cost. So it's quite easier. What you have to remember very carefully is the this annual factor that you are going to use. So this number should only take the decimal numbers that you have used. Okay, that you have used. So apart from that, it's a normal NPV problem. So thank you very much for watching this video. We'll meet in the next video.